Welcome back. 92 points on the Nifty, 11,783 is where we're at. So some information, Wipro detected abnormal activity in a few employee accounts on their network. So that is information that they're putting out to the stock exchanges, found abnormal activity in a few staff accounts due to advanced phishing campaign. So these are essentially sort of online security concerns that Wipro's account is highlighting. With respect to some of their own staff accounts, we don't know if they're highlighting this because there has been some impact on business or the like. We'll tell you what exactly this would amount to.
Today, so I think we'll just hear from the management soon enough as well.
I mean, I'm just wondering if this is something they've felt the need to put up to the exchanges. Maybe it could be meaningful, but that's what the news tells us as of now. Rahul Arora is joining us right now. Nirmal Bang, Institutional Equities. Rahul, thanks very much for coming in. Appreciate it. So the market continues to charge ahead. So first a quick short comment on what your thoughts are there. Then we'll move on to some sectors and stocks.
Absolutely briefly, Prashant, I think it's probably way ahead of where FY21 earnings will land up. So there is a fervor that's come into the market since the US Fed changed its tone, coincided with the election dates getting announced. The FIs have pumped in huge amount of monies. So who's to say it'll stop? I think it's caught most institutional investors by surprise. I don't think anyone expected us going into the election at 12,000 on the Nifty. It was probably a post-poll outcome. But I think I am a little worried, just given where I see consensus earnings on FY20 and 21, that this purely on fundamentals may not sustain. Liquidity is another animal. If it continues the way it is, who's to say it won't go to 12,500 as well? So, but the short point is I'm a little concerned.
Politics have the foreigners and clients that you speak to, they've all bought into these opinion polls headlong? Or?
So, Prashant, I think by and large it's discounted from the people that we speak to. So I don't think you're going to get, unless the BJP itself crosses 272, which would then be a very similar narrative to what you had in 2014. Right now, the opinion polls are projecting the NDA between 250 and 280. So the BJP, unless that narrative changes, I think is by and large in the price.
Rahul, you've initiated coverage on the insurance space, specifically on SBI Life, ICICI Pru. What is your call there? Are you liking the sector? SBI Life has been reporting good set of numbers. What's the upside there if it's a buy?
So, Ekta, we've initiated on the entire sector. In addition to the two names you mentioned, we've also covered Max and HDFC Life. But the two names you mentioned are our preferred picks in the space. Obviously, we know the broad theory of under-penetration and, how this... we actually believe this is the best way to play the entire financial space. Whether you look at banks, mutual funds, NBFCs or insurance, this we think is probably the best way to play financials from here, given that the Bank Nifty is already north of 30,300 or thereabouts. In the case of SBI Life, I think if you look at, its surrender ratio, its expense ratio, the complaints, the way the redressal of the complaints are, the bank assurance network of nearly 38,000 branches, the persistency ratio, if you see, is at about 114%. If you combine the 13, 37 and 61st month, which is quite phenomenal. 11% expense ratio, 20% ROE, nearly about 18% return on embedded value, coming to you at just about 1.8, 1.9 times FY21. And similarly for ICICI Prudential, I mean, it's got the second best persistency ratio after SBI Life at close to about 109%. If you take those same three metrics, the expense ratio again is at about 12.5, 13, which is second best to SBI Life. Bank assurance network again is very strong, and the good part about both these companies, Ekta, is that the productivity of the individual agency force, not just the bank assurance network, is very strong. And like I said, the good part is that the settlement ratio and the surrender ratios are very high. Like, just in the case of ICICI Pru, for example, if you look at their claim complaints and their policy complaints, one is just 19 in 10,000, the other is 87 in 10,000. So these are very strong metrics in a country like India. Even the surrender ratio for something like ICICI Pru Life was nearly about 10% in FY18. It's dropped about 7% in the first half of this year. So both of these companies are coming to you at about 20% ROE and about 16 to 18% return on embedded value. And both of them are at about 2 times price to book. We valued ICICI Prudential Life Insurance at about 2.4 times FY21 and SBI Life at 2.6 times FY21 earnings. Both of these roughly with a 25% upside. So I think if you're looking to build a portfolio in financials, these are probably two names you should have and keep from a long-term perspective.
HDFC Life is purely on account of valuations that
I think so, yeah.
keeping
That
away.
would probably be the broad
Because
call.
I think HDFC Life, I don't know if how large a factor it is on when you analyze companies, but it's got the largest portfolio of pure protection policies, right?
It
Which
does.
is also the most profitable.
It does. It does.
For-
In fact, if you look at pure protection or even participating products, Max Life may not be a bad way to play it, because this is stickier business. And if you look at the VNB margins for something like a Max, they're at about 20%. They must be about the third or fourth best in the industry. So you're right. I think HDFC Life did have a lot of.
But I think it's being priced in.
It has been. I think HDFC Life will probably be, from a valuation standpoint, probably the fourth in the pecking order. I think the only concern with Max, Prashant, is probably, because Axis was such a large distributor or bancassurance partner, and now because Axis is now sourcing a large part of its business from LIC, or rather LIC has made Axis a very large partner in its business. So to that extent, how will it affect Max's business is probably one of the reasons why it's trading at a discount. So if you see, Max is probably trading at 1.4 times FY21 price to book, which is at a reasonable discount. So I think the pecking order will probably be SBI Life, ICICI Pru Life, Max and HDFC Life, keeping in line the business outlook that I just spoke about, as well as valuations.
Just you cover the multiplex space, right?
We do.
So you must have seen that news. Ronnie Screwvala taking multiplexes
Yes.
to court, right? It's not been not been discussed, or the potential impact, or does it not have any impact? I mean, I just wanted to hear your thoughts.
No, so it's ironical that you bring it up, because we've actually spent a lot of sleepless nights trying to figure out exactly what this is. We met with Ronnie about 3 weeks back to discuss this issue with some institutional investors. My head of research, Girish Pai, looks at this sector. He's actually spoken to the CFOs of both Inox and PVR, and the numbers are very divergent. So Ronnie is talking about 3-digit crore numbers, and these guys are talking about low single-digit crore numbers. So there's probably a way of looking at it and the arithmetic to it, which is probably confusing right now. My sense is it's probably not going to be as serious as is being made out to be in terms of the numbers, if you believe what the companies have to say. And it's probably something that will tide over, just like the F&B sort of issue came and went. I'm not saying that this is like the F&B revenue, because that was probably had a more political color to it, but this is actually factual. It will have an impact on profitability, and if it sort of gets into the double-digit crores, so let's assume for Inox, if this number is like say 20 crores, it could probably be a third of their year's profit. So I don't know where that number will settle. Subject to that, I can't make an educated comment on it. But that aside, I think if you've seen the run-up in the Inox stock, the content that's come out and the margin expansion, is still probably a great way to play consumer discretionary, because you're getting it at sub 20 times.
Rahul, we've completely run out of time, but if you could just leave us with a target for Inox, because that stock has had a fabulous year already.
Well, so it has. My sense is, if you're looking at it from a one-year perspective, you can probably look at it with, say, a 20-25% upside, no more than from where it is currently. When we were talking about it, it was at a much lower P. I think it's coming to almost at 18 times right now. Still not that expensive compared to other consumer durable companies. But given the run, as you rightly pointed out, I don't think you can probably expect more than a 20-25% upside from a one-year horizon.
Okay, all right, Rahul, we're going to leave it on that note. Thanks very much for joining in and speaking with us about a whole host of sectors, insurance, multiplex, as well as the overall markets. We'll take a break now with the news that we have the Nifty, which is up around 89 odd points. We have the Bank Nifty, which is up around 1 odd %. On the other side, we'll be speaking to the management of Sandhar Technologies. Macquarie has initiated coverage on the stock. More on that company and the management once we're back. Stay tuned.